Hello everybody and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. My name is Scott Plaskett and I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. In today's episode, I have an update call with Charles Wilton, a portfolio manager at Raymond James Limited, a Canadian subsidiary of Raymond James Financial. Raymond James is one of the most respected investment management firms in North America. I love speaking directly to portfolio managers about their process. Process is so important to investing, and when I can get a portfolio manager to explain their process in plain English, we all benefit from this wisdom. Now, here's the call. All right, Charles. Well, listen, thank you for taking the time today. I know recently you've just done a disposition and an acquisition in the portfolio, in your portfolio, and I just wanted to have a bit of a chat as to what it was you sold. And then what you did with those funds that you realized from selling the company you sold, and then what you did with them, and why you bought the company that you bought. So I'm just going to kind of pass it over to you, and you can kind of tell us a little bit of a story as to why you sold what you sold and why you bought what you bought.
Okay, thanks, Scott. Well, we back in the financial crisis, which would have been fall of 2007. Of course, we saw the market collapse, and we saw the financials collapse, and the housing market collapse. And from our point of view, we're looking for volatility on the downside, good companies that people think that there's going to be a massive problem with them, and creates value for us. And certainly, Citigroup and the group of banks that we bought were substantial worldwide entities that, in my opinion, had no chance of going under for any particular reason. But because there was such panic in the streets, I went in and I bought Citigroup. Actually, I bought it November 19th, and I think we paid about $32.57 for it.
So it was November 19th of what year?
2007.
Oh, so November 19th, 2007. Okay.
So we bought it, and at that point, if people can remember, there was panic in the streets, and it was going to be all over, and so that certainly created a Christmas atmosphere for us, because that's exactly what we look for.
So you bought it. What did you buy it at?
Pardon?
What did you buy it for?
For $32.57.
32. Okay.
And at the same time, I bought more Wells Fargo, and I also bought more Bank of America, and I bought some Bank of Santander. So I bought of banks because that one industry was so hammered, and there was such high quality companies in that industry that I probably over diversified then to take advantage of what was going on in the marketplace. Right. And then fast forward it to today. We've seen all the banks come up, and we've started to see the banks slow down a little bit because a lot of the low-hanging fruit has been picked and the easy money's been made. And I'm looking to replace some of the banks because the portfolio, in my opinion, is a little over-diversified in banks, and we're looking for something of a higher quality to replace them, or at least Citigroup. So I decided to sell Citigroup and replace it with John Deere.
And just out of curiosity, what did you sell your Citigroup block for?
I sold the Citigroup for a little over $52.
Yeah, nice. Okay.
So again, we take advantage of what seems to be massive stress out there, and we look and we do a deep dive, and we find businesses that are good to great or number one or number two quality businesses. And we take advantage of the market misprice to go in. So a lot of people thought you're crazy going in there, but when they look at it now, that was fantastic. So, conversely, when people are way overpaying for the idea that they think that it's going to keep going on, they also pay the consequence. So I was looking at John Deere for a while, and John Deere.
So this is John Deere, you've got a website there you can just show. This is John Deere, the tractor company.
Yeah.
Yeah, okay.
Well, John Deere, most people are familiar with John Deere. It's a global player in the agriculture and construction business. John Deere is over 175 years old. They have 60% of the North American farm market. And when we look at globally, there are three companies that control over 70% of the global market, of which John Deere is the biggest of the other two. And they're in the agricultural business, they're in the construction business, and they're also in the financing business. Now, when we look at John Deere is off its high, and it's off its high, from me trying to give reasons why things happen in the future, why things happen in the past, and this industry is very difficult. But suffice it to say, as the market gets soft, and the market has been soft with China slowing, we get the corn production in the U.S. up, and we look at construction down. So we're looking at John Deere's revenues that have come off, their sales have come off, which has pushed the stock down, and this is where we get to what the market is mispricing in the company. So the stock has a high on $95, and now today $2. So I'm watching it go down, and then I'm checking and I'm looking at doing a deep dive and look at the value of the business and what the business is really doing. And it gets to the point that I say that the market is way mispriced John Deere, given the fact that John Deere is, in my opinion, is a good to great company, and it's a global enterprise, and it's going to be growing far outside of what the short-term cyclicality is. So when we look at we've seen it come off in the last year or so, and earnings have come off. So it's hit a slow spot, but we're looking at the 10-year return on operating assets on from 10% to 30%. And they're looking at sales of $50 billion by 2018, and half of those sales will be outside North America. They have record earnings per share 8 out of the last 10 years. And yes, it's cyclical on a short-term basis, but we know over time there's going to be more people on the planet. So consensus is by 2050, the world population will be somewhere around 9 billion people, and with those numbers, we're looking at a minimum of a 60% increase in the production of food, and that's globally. So we're buying John Deere at a price that at a value that we haven't been able to do in an awful long time. It's a $40 billion company. So when we look at what the market price is, which is what we bought it around 81, it's now 83. And we're looking at, as we do always in terms of the valuation and always in terms of what the economic book value is, and we all remember economic book value is the non-growth aspect of the cash net operating profit after tax that's been generated over the last 12 months, and we put that out into perpetuity, and we match it against what the market price is, and we get a ratio. And we know that if the market value of the company is equal to the economic book value, then the market is expecting that John Deere won't grow or won't lose. So the economic book value of 1 means that John Deere won't grow or won't lose any money. So when we look at the economic book value, we're looking at 0.7. So the market is telling us on a cash basis over the last 12 months that John Deere will lose permanently 30% of its operating profit forever. So the same as we did with other businesses of what we buy them and why we sell them, we take advantage of the fact that it's usually 80% about the price. Now, it's 80% about the price when we're looking at solid, high-quality businesses, number 1 and number 2 in their industry. And we have some predictability to it. So we're not in companies that they're up and down 50%, and it could go out of business. So the quality of the business, the quality of the predictability, and us looking at what the cash flows have been gives us a lot better insight as to what we can expect in the company over 2, 3, 4, 5, or 6 years.
Yeah, and so basically what you're saying now is that this company is, the market is saying it's supposed to be losing 30% forever, yet the return on invested capital is showing here that it's been up, 19%. So it's got a return.
And that's a real return. When we look at the numbers here, we're looking at numbers that are very conservative. So when we look at economic return on invested capital, the ratio and the way that we calculate that is a lot more conservative than you would be just in the general public and how they look at it. We're very conservative with this. So yes, they have a 19% return on invested capital. They have a free cash flow yield at 8.2%, which is really fantastic given what the stock's been doing or given where the market is. So it's like anything else. We know what good businesses are. The same as when we sold Nike. We sold Nike. We made a lot of money in Nike. But Nike's still a great company. What we hope is that Nike will come down. We can buy Nike again.
Right.
We just don't want to. We don't want to own good businesses that we pay too much money for.
Yeah, it makes total sense.
Trying to make money.
Yeah, it makes
total
sense.
So I don't like selling the companies. I like to buy them. I don't like to sell them. But I sell them because the expectations get overvalued and undervalued. So what we're trying to do is take advantage of what the market is saying rather than what my opinion is about what's going to happen in the future.
Right. Yeah.
So I don't know whether I don't know what's going to happen in the farm implement business 10 years from now. And I don't care about what's going to happen. But what I do care about is doing a deep dive on the numbers and trying to find opportunities where the market, in our opinion, is making a mistake.
Yeah. And so the transaction that you did, because these are both U.S. companies, the Citi Group sell to the John Deere purchase, was there any currency issue with that? No. And of course, we know that in a registered account, we can't keep foreign currency. We have to keep Canadian currency, even though we own U.S. stock. So what would happen is when we sold Citigroup and bought John Deere, but we netted the trade out. So there was no currency no currency trade in there. Right. Yeah, so that's nice. That's nice as well. Super. Well, that's great. Well, I mean, yeah, well, I mean, it makes sense when you go through the details and you say, here's a great company, and the market just doesn't for some reason appreciate the greatness of the company. And so it's, the prices kind of drop down and it suddenly shows up on your radar screen and says, hey, this is a great company you can get for, 70 cents on the dollar. Which doesn't happen very often for $40 billion companies. So that's fantastic. Anything else you wanted to talk about on this? I mean, that kind of covers the rationale for the sell of Citigroup. Wanting to make sure you weren't so concentrated or didn't have so much concentration in your portfolio in the financial sector. So it's time to get rid of Citigroup. Not to say Citigroup is a bad company, just you needed to get rid of one. And then buying John Deere.
It's always a case of trying to increase quality.
Yeah.
And of course, when the markets are fluctuating, the markets are down. This is why I always say it's way more fun when the market's down. Because all of a sudden you get a lot more quality. Like we're buying Porsches and not buying Volkswagen. So there's a lot of really high quality businesses that we have an opportunity to own. Yes. The other thing is yes, because there was such a massive hammer in the financials. I bought more of a basket than I would normally to take advantage of it. But as it turned out, that was okay to do that. So when people look at buying these businesses and selling the businesses, especially buying them, think about John Deere as your own company. You own John Deere, and it's a family business, and you've had it for many years, and you see how big it's grown and how profitable it's gone and how the management has changed and how the management is building a global empire and how things are moving along. 8 of the last 10 years record earnings, and you're taking over, the highest percentage of the global agricultural industry. and then all of a sudden we get a little blip for a year or so, and you think, okay, well, it's all over now. We have to sell the company. That's why we take advantage of the good businesses and the predictability factor of the good business. So we'll buy John Deere. I don't know when we're going to sell John Deere. We'll sell it when we think that the market expectation is way too high for the company. Doesn't mean it's a bad company. It just means that we want to buy businesses at good value and then sell them when the market is expecting too much. And that's how we create value and we build our businesses. We build the value of the companies or the accounts.
Yeah, yeah. No, it makes sense. And I mean, that's why I like going through these calls with you, because it does sort of bring it down to the sort of the essence of, let's not forecast. Let's not say, oh, well, we're buying this because there's going to be more people on the planet and because we expect that there's going to be, the need for more equipment. That's not why you're buying this, apparently. You're saying, no, we're buying this because the company has been managed so well and it's been growing and doing everything properly. It just so happens that right now, for some reason, the market is saying, hey, the price has just dropped down to a level that's below the value. And so it's picking up dollar bills for 70 cents. And that makes sense. It's not relying on, will populations expand and that sort of thing. It's not dependent on that. It's just saying that this company is such a great company that knows how to make decisions based on what's happening in the marketplace, yet the market's not recognizing that this is a great company. They're just, for some reason, and it could be a short-term event, saying that it's not worth, that it's going to actually go down in value. But, you do the math on it and say, well, that doesn't make sense because it's been hitting, you said, in the past 8 of 10 years, hitting a sort of, record earnings and just doing everything right, yet the market's not rewarding it. So that's
well, it's the same as the old adage of jumping over a 7-foot bar. Why try and jump over a 7-foot bar when you can step over 7 1-foot bars?
Yeah, exactly.
So we know, and prudent people would make the bet that John Deere will be selling more machinery and more entities 2 years and 3 years and 4 years and 5 years from now than they are today.
Yeah.
It's like Coke. They're going to sell more. They're going to grow the business. Now, the reason we do it with John Deere, we do it with Coke, we do it with those businesses, their predictability and their good to great businesses. We don't know that with a ton of other businesses of which we're not willing to make that bet.
Yeah, that makes sense.
We don't know. We don't know.
Yeah. Well, listen. Well, thank you so much for taking the time and going through that. And I know it helps everybody who owns your portfolio and just gives them some clarity as to why a change has taken place. Why did Citigroup suddenly leave the portfolio? The answer to that is because a little bit of concentration in the financial sector, want to diversify a bit, found a company to diversify into that's currently a great company that is currently at just the price is just happens to be at a really good point for buying this great company. So that makes a lot of sense. So thank you for taking the time for that. And I always look forward to our calls, and I look forward to the next one.
Okay. Thanks, Scott.
Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment and we'll respond directly online. If you would like to take advantage of a free, no obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter, twitter.com/IronShieldCFP. Like us on Facebook, facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.